Taxes in retirement do not have to be a guess. In the next few minutes, I'll show you a simple way to decide if a Roth conversion truly makes sense for you, when to do it, and how much to convert. For those of you who don't know who I am, my name is Tyler Lavoie. I'm one of the co-founders and senior wealth advisors at Guardian Financial. My job is to help near retirees turn their savings into income. And as a disclaimer to you, this is just education only, not personal advice. If you're looking for something a little bit more tailored to you, feel free to book a 30-minute consult and we can dive a little bit deeper. So the big question that a lot of people have is, what is a Roth conversion? A Roth conversion simply moves money from a pre-tax account like a traditional IRA or an old 401k into a Roth IRA. And what happens is you pay income tax now on the amount that you move. In exchange, future qualified withdrawals from the Roth IRA can be tax-free. There's no income limit to convert. You can convert at any age. Since 2018, you can't undo a conversion, and you must finish by December 31st to really count in that tax year. The question that many people ask is, why do people do it? And it really comes down to three common reasons. The first is tax rate arbitrage. So you pay tax at a known lower bracket today just to avoid possibility of higher tax rates later. Secondly, people look at it for future flexibility. Roth dollars don't have required minimum distributions or RMDs, so Roth money is actually a lot easier to control. Third, people will use it for estate simplicity. And so what that really means is heirs often prefer Roth dollars because the withdrawals can be tax-free. Number one is gap years. This is when after retiring, but before Social Security, pensions, RMDs start, your taxable income may be temporarily lower. Secondly is market dips. So this is where you're converting shares while values are down, which means paying tax on a smaller amount and letting the recovery happen inside of that Roth. And third is before potential tax changes. So this is where your current brackets are scheduled to change after 2025. So some families fill lower brackets now. So then the third question that we see is, how much should you really convert? And this is really a simple rule of thumb. So what you want to try to do is pick a target tax bracket and fill it, don't spill it. You then want to look at your projected income for the year. And when you're looking at these projections, they can help give you a better idea of where things are going. Then you want to decide the top bracket you're comfortable with paying because you're going to be filling the difference. And so when you're converting this, you're only converting the amount that keeps your taxable income below that top of line bracket. Because remember, taxes are progressive. And if possible, you want to pay the tax from the cash outside of your IRA. So you get the benefit of that full conversion amount, and that keeps compounding inside of the Roth IRA tax free. And so this is a starting point because healthcare credits and state taxes can really change the targets for each individual. This is why you need to really dive deep on your personal situation. If you're subject to an IRA RMD this year, you must take the RMD before converting any additional amount. And so when you convert an RMD, there's a 5-year rule you need to really consider. And when you're doing the conversions, each conversion that you do has its own 5-year clock to withdraw that converted principal penalty free if you're under the age of 59 and a half. After 59 and a half, this penalty rule isn't an issue that you have to necessarily worry about. Also, for Roth earnings to be tax-free, your Roth must be 5 years old and you must be 59 and a half or meet other qualifying conditions in order to receive those funds. And so when it comes to the pro rata rule with IRAs, if you have both pre-tax and after-tax IRA money, any conversion is split pro rata across them. And this is generally tracked on the form 8606. And so keep in mind the deadlines. So conversions count in the calendar year that you do them. So not like next April for like contributions. So what people want to really look out for and don't get tripped on, because it happens all the time, is when it comes to Medicare, those IRMA surcharges. So conversions really increase your modified adjusted gross income, and that basically raises your Medicare Part B and D premiums 2 years later. So there's a 2-year look back on those. When it comes to Social Security taxation, this can also get impacted by conversions because it can push more of your Social Security income into taxable income. Most people generally pay 85% of the income is considered taxable, but if we can try to reduce that, you want to try to do that as much as you can. And so when it comes to health insurance pre-65, higher MAGI can actually reduce your premium tax credits. And so with some states' tax conversions, you want to make sure you're very aware of what your state tax is too, because that's where you're going to weigh in the benefits of doing it now or doing it now, waiting later, or not doing it at all. When it comes to withholding, you want to avoid having tax withheld from the conversion itself, and you want to pay from cash if you can, because you want to try to get as much money working for you tax free. So if you have that cash just sitting idle, it's going to benefit you more in the long term with more money working for you. And these aren't really deal breakers, but you just want to plan the amounts and the timing. That's really the key points here. And so something that we can kind of use to give you a little simple example here. Let's just say someone retired at 64, there's no Social Security yet, and they have modest dividends. And so what you want to look at is maybe converting just enough to fill your target bracket. And so what you end up doing is you lock in today's rate and reduce your future RMDs. Example B, let's just say the market's down 15%. You convert shares while they're lower, future rebound grows tax-free inside of the Roth. And then let's say example C, when it comes to estate stuff. So parents in steady brackets convert a set amount each year. Adult kids inherit fewer taxable surprises for them inside of the Roth. And so when you're looking at how to do it, there's some simple steps you can consider. So step one is you want to estimate income for the year. So you really want to pick a top bracket you will not exceed. So it's looking at the cap threshold. Second is you want to run the numbers. So you can use a tax software or work with a financial advisor like myself. Third is you can execute the conversion at your custodian. So when it comes to this here, if you're doing an IRA to Roth or an in-plan Roth, if it's allowed. Fourth is you can pay taxes from cash. Keep records for your Form 8606. This is really important because you want to make sure you're documenting everything, because when every conversion that you do, there's that 5-year look back. So keep that in mind. And then step 5 is repeat annually if it's really still worth it. And you can still run the conversion analysis to give you guys a better idea of what's really going on, if that's really going to help you year over year in the greater scheme of things. And so just a bit of a quick recap, because there's a lot of information here. Roth conversions generally trade tax now for flexibility later, and they often shine in gap years during market dips or to shape future RMDs if you have a very plump IRA or tax deferred account. And so you're converting to a bracket, mind the 5-year rules, and watch for the IRMA and credits when it comes to your Medicare costs. And so if you want a quick plan whether a conversion fits this year and how much to really do, feel free to book a 30-minute consult. Anyone from our team here would be more than happy to have a conversation with you. And keep in mind, this is educational only. It's really just to help you guys understand what you're doing. My name's Tyler Lavoie. Look forward to connecting with you soon.